What's up, everyone? Today we are having a topic about FHA loans. So if you are buying or want to learn about FHA, this episode is for you. Watch till the end because we're going to drop a lot of information that is going to help you when you qualify for loans when you purchase. I'm here with Jaime Cervantes from Prime Equity Mortgage. He is the right person to talk to or ask questions. I'm going to leave his details in the description below so you could reach out. Thank you so much, Jaime, for coming to this episode about FHA. So I'm going to ask you the first question. What is an FHA loan?
So basically, an FHA loan is a government loan, okay, that allows first-time homebuyers to come in with a very low down payment of as low as 3.5% down, right? The good thing about this program is that it's very easy to qualify. The credit requirements are very, very lenient, so you can have a 580 credit score and still qualify for this loan. The way that it works is that since it's backed by the government, there are some fees involved. So one of the main ones is what's called the upfront mortgage insurance premium. Basically, what this means is it's a fee paid not to me, not to my bank, but directly to HUD,
okay,
the Department of Housing and Urban Development. And basically, they charge this fee of about 1.75 of the loan amount so that the program can keep on going, right? So that more people can use it in the future. Now, you can pay for it up front or you can finance it into the loan.
But it'll be very high.
Exactly. So most people just choose to finance it and pay off with their mortgage payment.
Mm-hmm.
So that's one of the main popular programs right now for people that are buying their first primary house.
How about the mortgage insurance for that?
That's a great question. So typically, for example, on a conventional loan, after you hit 20% equity, the mortgage insurance falls off. Or if you come in with the 20% down, you don't have to pay mortgage insurance. On an FHA loan, however, if you come in with a very small down payment or the minimum, you're pretty much paying mortgage insurance for the life of the loan, right? Even if you put in, let's say, a 10% down, you're going to be paying it for at least 10 years. So this is why a lot of people typically refinance out of an FHA loan into a conventional loan as soon as they hit 20% so that they can remove that mortgage insurance. So one of the cons about an FHA loan is that it's a little bit more fee heavy. But in an environment like this with the economy the way it is, an FHA loan typically has more favorable terms than a conventional loan.
What do you think the pros and cons of FHA loans?
One of the biggest pros for an FHA loan is other than the down payment, is the credit score. So you can even go less than 580, but you just have to come with a bigger down payment. Okay, that's one of the biggest pros of it. Okay, the biggest cons of it is if you're using an FHA loan, and if you're legally married, for example, and let's say your spouse has a lot of debt, you have to take her debt into consideration as well. So as an example, let's say I'm buying a house, and I'm married. My spouse has a lot of debt, but she's not going to be on the loan. I still have to take into consideration her monthly obligations. So if she has a big car payment, if she has a lot of student loans, collections, I have to take that into my file as well.
It's going to affect the
It might
file.
affect my qualifications as well. That's one of the biggest ones.
Mm-hmm.
Another one is that when it comes to an FHA loan, let's say you wanted to buy a condo, right? You have to make sure that it's approved by FHA. There's a lot of condos out there that aren't approved by FHA, so they're not able to go that route. So you would have to kind of shift a little bit and go to a conventional loan. That's one of the biggest cons.
Tell me about, Jaime, about the things in a home or in a condo that will disqualify you from using an FHA, because that's an important point.
A lot of the times when it comes to qualifying using an FHA loan, one of the biggest things that disqualifies a condo from being, not being able to finance from FHA loan is if it's a non-warrantable condo. As an example, a lot of the times if it's like if the HOA standards doesn't meet the guidelines for FHA guidelines, then you can't go FHA on that program, or even conventional for that matter. Now, when it comes to FHA loans, they are a little bit more strict on the actual condition of the property too. So if you want to buy a property, but it needs some work, like if there's chipped paint, any potential hazards that might be called out, FHA might not be the best one to go because they're a lot more strict on that if there's any potential hazards on that property.
Okay, that's a big point to deter people from using FHA.
Exactly.
Yeah.
Other than that, it's a very good program to buy if you're a first-time home buyer. But the other pro that I see for an FHA loan is that it's a 30-year fixed, right? Usually the rates on an FHA loan are a lot lower than on a conventional loan or any other program because they're backed by the government. So, their rates are typically favorable.
Okay. So, Jaime, my follow-up question is, how does it compare to conventional when you buy a multifamily, like more than like a duplex or a triplex?
Perfect.
Compared to conventional loan?
That's a very good question. So you can buy a duplex with as little as 3.5% down, but when it comes to a triplex or a fourplex, there is something called the self-sufficiency test on an FHA loan that typically in these high interest rate markets, it doesn't pass. Basically, what a self-sufficiency test rule is, if 75% of the rental income from the property does not cover the actual mortgage payment, you cannot go FHA on that property.
Okay.
The reason why this rule is in place is because the lender wants to make sure that that property is self-sufficient in case you decide to move out.
Exactly.
So as an example, let's say each unit rents for $2,000, so $2,000, $4,000, $6,000, and the payment on the house is $5,000. 75% of that would be, I think, $4,500. In that case, it's not going to cover the mortgage payment.
Okay.
So you would not be able to go FHA on a triplex in this specific scenario, but you can go conventional, a little bit higher down payment, 5% down, and there's no self-sufficiency test.
Okay.
So that's the biggest update that has just recently happened with conventional loans. Before, when you wanted to buy multi-units, like
you have to come up with a higher down payment.
Either 15 or 20% down. But now with the new Fannie Mae updates, very big, yes. Now with the new Fannie Mae updates, you can buy a triplex or a fourplex, putting 5% down, as long as you're living in that property.
I was about to say, it has to be owner occupied.
You can't buy it as an investment and then put 5% down. If that's the case, it's like 25% down minimum.
Exactly.
As long as you're living in that property, it's a lot easier to house hack a triplex or a fourplex versus an FHA loan.
Exactly. So how about the example you gave me with FHA, it's owner occupied? Or
every FHA loan is owner occupied. Yeah, no matter, you can't buy an investment property with an FHA loan.
Okay.
These programs are designed as your primary residence. So
to
exactly, yeah. So
secure the government.
Exactly. So the good thing about it is if you're buying a duplex, I would go FHA 100% because there's no self-sufficiency test, and you can put as little as 3.5% down. And obviously,
that's amazing.
You have to be living in that other unit to be able to qualify.
Unit. Sounds good. So I always heard back in the past that FHA, you could do it only once. You cannot buy two properties using FHA, correct? You have to
there are certain,
change it to conventional. So tell me about that.
So there are certain exceptions. I had a client who lived in Southern California. He had an FHA loan, but his job was relocating him up to, I believe, Monterey Bay.
Okay.
So Monterey Bay from...
Like up north.
It's up north. Yeah. It's kind of a distance. So in that situation, if it's more than 100 miles away from your current primary residence, you can still qualify with that FHA loan. But you definitely have to live in that property, and there has to be a good reason why you're moving up north.
Because of the job. So you have a... Yeah.
Exactly. In this case, his job was relocating him. Okay. So his primary residence was in SoCal. I believe in Moreno Valley was where his primary residence was. Okay. But his job was relocating him to Monterey Bay, which is a big drive.
Big drive, yeah.
So if that's the case, then you can have another FHA loan as long as it's more than 100 miles away.
Okay.
But typically you cannot have more than one at the same time. Exactly, yeah.
So even with the Monterey Bay example, you cannot have both FHAs at the same time?
You can. If you can have, like, for example, his primary residence was FHA.
Okay.
In this case, since his other property is 100 miles away.
Yes.
And he's moving into that property, then in that case, you can go FHA.
Okay.
But if it was less than 100 miles, you wouldn't be able to do it.
Sounds good.
You can use FHA more than once in the past. So as an example, let's say you bought a house a long time ago with an FHA loan and you sold it, you can still use it again. But
because you exited of
Exactly.
that property.
Exactly. But
Yeah.
90%, 99% of the time, you're most likely going to use an FHA once.
Okay,
After that, you're going to refinance into a conventional loan,
got it.
or your next property is going to be with a conventional loan
Okay,
most of the time.
awesome.
Mhm.
See, I told you guys, it's a lot of information. I did not know that.
Yeah.
Now
a lot
I
of people
know.
don't know that.
Yeah.
It's good.
Awesome. Thank you so much. So, Jaime, my follow-up question to that is, what are the new guidelines that provided by the government recently about FHA loans that the home buyers need to know? Can you talk about it?
Good question. So one of the biggest changes that happened with the FHA loans, a few months ago, when you wanted to use an FHA loan, your mortgage insurance was a little bit more expensive. It was about
Okay.
85 basis points,
Okay.
which on a $500,000 loan amount translates to about $350 to $400 a month of just mortgage insurance. Now they reduced it to about 55 basis points. So from 85 basis points, which is about $350 to $400 a month, to 55 basis points, which is about $250, you're pretty much saving about $150 a month in your mortgage. So basically, in a
Great saving.
great savings,
Yeah.
because the mortgage insurance is now a lot cheaper.
Okay.
Before, when the mortgage insurance was at 85 basis points, conventional, assuming your credit was very good, conventional mortgage insurance is very, very cheap, right? I've seen some that were $100 a month, right? But now with the new guideline update with FHA, and now at 55 basis points, you're pretty much saving on average about 100 to 150 a month.
That's great.
Exactly,
That
yeah.
increases your buying power.
Exactly, and not
Yeah.
only that, but you're saving a lot of money too.
Mhm.
So it makes in an environment with the rates are very high, it makes an FHA loan a little bit more favorable.
Awesome.
Exactly.
Awesome. Thank you so much, Jaime, for this lovely talk about FHA loans. I really appreciate it. I learned a lot. Hopefully, you guys learned a lot today. And if you like the content, please like, share, subscribe, show it to other friends so they could benefit. And I will see you in the next video. Thank you so much, Jaime.